All right, team, settle in. Today, we're getting our hands dirty. We're moving from the classroom to the trading desk. And I'm going to walk you through a professional-grade framework we use every day to cut through the noise. This isn't about finding some magic indicator. It's about building a disciplined, repeatable process that gives us an edge.
So here's how we're going to break it down. First, we're going to tackle the biggest trap for new analysts, what I call the analyst's dilemma. Then we'll dive into the triple threat framework itself, layer by layer. We'll cover how to find the trend, how to pinpoint an entry, and then how to get that final confirmation. And after we see it in action, we'll finish with the one thing that truly makes or breaks a trader: discipline.
Okay, let's get right into the biggest problem I see. The number one most expensive mistake a new analyst makes is trying to be a hero. Fighting the primary trend, trying to catch a falling knife. They see a price drop and they think, oh, it's on sale, without stopping to ask if it's a healthy pullback or the beginning of a total collapse. Look, our job is not to predict tops and bottoms. Our job is to find the strong current and ride it.
So that leads to the big question, right? What's the secret sauce? How do you get consistent returns instead of just getting lucky once in a while? Is it some secret algorithm? Insider info? No way! The answer, the real edge, is having a disciplined, rules-based system. It's about having a process that tells you what to do so that fear and greed don't get a vote. Your process is your paycheck.
And that's where this framework comes in. We call it the triple threat trigger. Now, don't think of this as some kind of black box system. It's just a logical filter. It has one job, and it does it really well. It forces us to be patient and wait for that perfect moment when multiple conditions align, and the odds are finally stacked in our favor. The whole thing is built on 3 layers, and you have to check them off in this exact order. No skipping steps. First, we figure out which way the river is flowing. That's the trend. Second, we look for a very specific tactical spot to get in. And third, we get one last piece of confirmation that the trend is still strong. Until all 3 of those are a yes, we don't risk a single dollar of the firm's capital. All right, let's start with layer 1. This is the foundation. Honestly, if you get this part wrong, nothing else we talk about today will matter. Before you even think about an entry, you have to establish your bias. Are we buyers or are we sellers? Making this one decision correctly will automatically filter out half the bad trades you might be tempted to make.
So how do we do it? Our main tool for this is the exponential moving average, or EMA, specifically a longer-term one like the 50 or the 200. I want you to stop thinking of this as just a line on a chart. Think of it as your North Star. It sets our entire macro view and tells us, without a doubt, which side of the market we should be on.
And the rule here is incredibly simple. It's black and white. If the price is trading above a rising EMA, we are buyers. We are only looking for opportunities to go long, period. If the price is below a falling EMA, we're sellers. We only hunt for shorts. And here's the most important rule of all. If that line is flat or the price is just chopping back and forth across it, we do nothing. We sit on our hands, we go get coffee. A flat market is a coin flip, and we're not in the business of gambling.
Okay, so once we know which way the wind is blowing, we move on to layers 2 and 3. This is where we shift from the big picture strategy to the nitty-gritty tactics. This is how we find the exact moment to pull the trigger. For our entry point, we use the CCI. Now, listen up, because this is where a lot of retail traders get it wrong. We are not using this to call a big market reversal. Think of it like a slingshot. We're using it to find that moment of maximum tension on a pullback, right before the price is likely to snap back in the direction of our main trend. So let's walk through it for a buy trade. First, we're patient. We wait for the price to pull back to our EMA, our zone of value. As that's happening, we watch the CCI. We need to see it dip down below the negative 100 line. That tells us things are getting a little oversold, but we don't buy yet. The signal, our green light, is when the CCI crosses back up above negative 100. That's the sign that momentum is shifting back in our favor.
But wait, before we hit that button, we need one final check. This is layer 3, our ultimate confirmation. For this, we use the MACD histogram. I want you to think of this as our underwater radar. Price is the choppy water on the surface, but the MACD histogram tells us what the submarine, the real underlying strength of the trend, is doing deep below.
And the rule here is very specific. Ignore the MACD lines themselves. We only care about the bars of the histogram. For our buy setup, as the price is dipping and the CCI is down below negative 100, these histogram bars must stay above the 0 line. What does that tell us? It tells us that even though the price took a little breather, the big picture buying pressure is still positive. The bulls are still in control. This is what separates a healthy pullback from a dangerous reversal.
All right, the theory is done. But theory doesn't make us money. Execution does. So let's walk through a perfect buy-the-book trade setup on a 1-hour chart and see how all 3 of these layers come together.
So, check this out. Step 1. Trend confirmed. Price is clearly trading above our 50 EMA. We're bullish. Step 2. Pullback. Price comes right down and kisses the EMA, our value zone. Perfect. Step 3. The conditions. We look below. CCI has dropped below -100, and critically, the MACD histogram is still above 0. It's a healthy dip. Step 4. The trigger. The CCI crosses back up over -100, and we're in, we buy. And what's the very next thing we do? Step 5. Define our risk. We place our stop loss right below that recent swing low. And that brings me to risk management. A perfect setup is worthless if you don't manage your risk correctly. We have a hard rule here. We never, ever take a trade unless the potential reward is at least 3 times our potential risk. This is the math that keeps us profitable long term. It means you can be wrong half the time and still make good money. Think about that. That's your edge.
Okay, this brings me to my final and most important point today. I can give you the world's best system, the best tools, the best everything, but none of it means a thing without discipline. The framework is just a tool. Your ability to patiently and consistently follow the rules, that is the real edge.
Look at this. This is the choice you make every single day. The professional waits for everything to line up. They accept their small planned losses and move on. They focus on executing the process perfectly. The beginner, they get impatient. They force trades that aren't quite right. They fight the trend. They're just chasing a random win. You have to decide which one of those you're going to be.
So I'll leave you with this. A system is just a map, but discipline is what makes you follow the map instead of wandering off into the woods. The ability to sit there on your hands and do nothing when the setup isn't perfect, that is the highest skill of a professional trader. All right, enough talk. Let's go find some setups.